G'day and welcome to another episode of Perth Property Insider. I'm your host, Jared Mann, and today I'm really excited to have my financial planner slash accountant slash finance broker, Stuart Wemyss, along from Pro Solution Private Clients, where we're going to talk about how to minimize your tax over the three phases of investment. Now, this is a bit of a different approach to what most accountants you would speak to would take, where they predominantly focus on the short term and forget about the longer term when you actually need your income as you move into retirement, and where tax is going to play an even more significant role in what you end up with when you need it most. So I've had so much good things to talk about with Stuart here that we've split it up into two parts. In this first part, we're going to touch on understanding the three phases of a property's life and the tax considerations in each phase. And then we're going to deep dive into income tax considerations and land tax considerations in part one. Stay tuned for part two because we've got a lot to cover in that one as well. For now, let's go inside.
Welcome to Perth Property Insider, where you will learn how to grow your wealth and improve your life using Perth property. Our show is brought to you by Investors Edge Real Estate, the highly rated and award-winning property management specialists servicing the whole of Perth. Now, here is your host, Jared Mann.
Well, can you believe in a year of running this podcast, we've not touched on any accounting topics? I thought it would be ideal to not just cover something accounting related, but also in an interesting way. And what better person to give us his insights than Stuart Wemyss? Hey, Stuart, thanks for joining us today.
Hey, Jared, pleasure to be with you. It's just a surprise that tax wasn't the number one topic to talk about and to think about. Hey, it's such an exciting topic.
Well, we've covered so many other topics that I actually posted on our Perth Property Investment Facebook group what people wanted to hear about, and we had quite a few requesting tax. So we've finally got around to it.
It's funny. It's not an exciting topic, but it's one that everyone wants to hear about because I guess we don't necessarily lament paying our fair share of tax, but we certainly don't want to pay any more than our fair share. So it makes a bit of sense.
And it's one of the other certainties in life, isn't it? We've got
That's
death
right.
That we don't look forward to, and taxes would be right up there.
You might even add lockdowns to that list, but hopefully not.
Well, not as much for Perth. So I know
No,
you're
that's
fresh
right.
off your Melbourne experiences. And look, it would seem most of us just go out and buy a property first and worry about tax later. That's one camp. Other people worry too much about tax and go and buy the wrong property. And then even if they do give tax some considerations, they're so focused on the short term that they often miss the larger picture of how things will look in the future when it really matters, when they really need the income in retirement. So what are some of the things that we should start to think about tax from a longer term perspective?
I think it's important to acknowledge and recognise that property really kind of has three tax phases through the journey, and each of them give rise to different tax considerations. So focusing on one phase, particularly if we're going to be long-term investors, will potentially come at the cost of other phases. So there's no magic bullet here typically, but it's really about balance. Like everything in life, you've got to balance out the pros and cons and find what is that kind of equal balance. And you could do that on a property basis, or you could even better think about it on a portfolio basis and look to balance those things out. So there's three stages, as I said. So let's talk about them. The first
and this
stage
is where people often get it wrong because they don't appreciate the stages, and they might rush out and try to fulfill requirements of the later stage, but then they don't get their initial growth that they need in order to produce the income later. Take us through the stages.
Yeah, or worse still, Jared. I mean, sometimes people will come to us and say, we want to invest in property because I want to save tax. And I say, well, saving tax is a consequence of investing property, not a reason to do it. So sometimes they're chasing those tax benefits without then thinking about potential tax liabilities down the track. So,
and look, sometimes it's the accountants.
Yeah, that's right.
I don't want to slander the rest of the profession, but they're often like, you're paying too much tax, need to save some tax, go buy a property. And that's the level of sophistication that they're getting advice on. So,
yeah, absolutely. It can be too short-term focused. So the first phase is the negative gearing phase, one that's been well publicized and talked about. And sort of one of the attractions, I guess, that some people consider when contemplating investing in property is that you can offset the income loss from your property against other taxable income, thereby saving you some tax. Or putting it in a different way, the tax man is going to give you a refund to help you with the cash flow cost of holding that property. And so that negative gearing phase, it greatly depends on what the prevailing interest rates are and how interest rates change over time. Because, you got to buy a property today and you pay 3% in interest, your negative gearing benefit's not going to be that substantial. Whereas,
and I guess it can depend on your tax bracket and
it definitely depends on your tax bracket, but the interest rate element is the biggest, the biggest component. So that first phase, that negative gearing phase, where you're getting tax savings from investing in property, can typically last anywhere from say 5 to sort of 12 or 13 years. And so, and particularly in those earlier period, that 5 to 7 year period, you might be enjoying material tax savings. And then after sort of 5 to 7 years between that and sort of 12-ish odd years, the savings aren't that material or that significant. So that's the first phase.
Why would that be, Stuart? Is that because typically if interest rates are a bit higher, the property's moving, its rents are increasing in line and moving more towards a neutral and positive position, I would imagine, over time?
That's right. Your loan value doesn't change. Your loan amount, I should say, doesn't change over time, but the value of your property and therefore, hopefully, the value of the rent that you're receiving changes over time with it. If it's inflation or just general market conditions, of course, you could speak to that better than anyone else. And so just generally, you should hope that if you're renting a property today, you're getting more rental income in dollar terms than you were 10 years ago. But the interest component's the same. It's just really relevant. The loan balance is the same. It's just really a consequence of what is the interest rate at a particular time. But generally,
the next phase, what's after the negative gearing phase? What's next?
So it'll go through a neutral phase where there's no substantial tax savings, but there's also no substantial tax liabilities. The property is pretty much break even, or it might be at a slight loss or slight profit, but it's not material. It's not a big deal. It's not really having impact on your overall tax position. And then the final phase is a sort of tax liability phase, if or when you decide to divest of the property. And by that, I'm talking about capital gains tax, because hopefully after you've held the property for 20 plus years and you've bought well, hopefully you've got some unrealized gains there that you need, that if you go and sell, you're going to pay a very large amount of capital gains tax. And, we all go and buy, or the mantra is buy and never sell. And it's a good mantra because the longer you leave a property or longer you hold a property, the better the compounding growth works. Particularly in dollar terms, it can be, very substantial. And
the more the chance of catching those cycles too, because everyone worries so much about timing things perfectly. But as we've seen in the unpredictability of the last 12 to 18 months, you never know what X factor is going to kick in a growth period and for how long it may last.
And also the other thing too, Jared, I find that more experienced investors can ride out those periods of volatility, because if I bought my property 20 years ago and I paid $500,000 for it and it's worth $2 million today, whether it's worth $2 million or 1.9 or 2.1, that the value can jump around a little bit, have a little bit of volatility. I don't really care. Either way, I've got more than $1 million of equity, or close to $1.5 million of equity in that property. I've done well. Whereas if you bought in 2 or 3 years ago, your equity is much smaller in dollar terms. So the volatility really does change how you kind of feel about that investment and how it's performed, and change your financial position. But we can't take property with us. We've got to do something one day, whether we gifted on to our family members or beneficiaries. Or most importantly, the whole point of investing is to build wealth so that you've got a secure financial situation to fund retirement. So, which could include divesting of a property at some point. So it's, one of the benefits of developing a long-term strategy is to ascertain whether that's necessary. And then if it is necessary, well, you want to start then thinking about, particularly if you want to build a property portfolio, it could be go and buy 3 properties and sell one, and you sell that one to reduce debt, for example, or increase liquidity and so forth. Well, with that one property that's earmarked for sale, you want to start thinking then about capital gains tax. And is there a way that you can go about minimising that, or at least giving yourself the flexibility to minimise it should you need to sell?
So what are some of the other taxes in that phase? And we can go deeper into them in a minute, but they start to become more material then, don't they? And what was not a factor in the first 2 phases can start to become quite real. And this is one of the things that's opened my eyes in doing some research for this episode. I didn't appreciate the scale.
Land tax is probably the most insidious, because when we go and buy an investment property, it's quite often it might not trigger land tax, particularly if it's our first one. Most land tax is a state-based tax. So it really depends. It's levied on the land value, not the actual total value of the property, but just the unimproved land value of the property that you might hold in different states. Yeah. So if you go and buy...
And of course, we want our land value to be a pretty significant component, because that's what does the appreciating over time, and the building does the depreciating over time. So
absolutely,
we want that to grow.
That's right. So if you're paying a lot of land tax, it's a good sign or good signal you've got a strong land value component, except for the fact it's a tax and it's a donation to the state government that we might not necessarily really voluntarily make. So always good to think about it and try and reduce it. But each state has a land tax 3 threshold. So quite often you can go and buy your first investment property and it might not trigger land tax. But then once you buy your second investment property, or that first property starts to appreciate in value, that's when land tax can start to arise. But if you think about it, if you buy an investment property in your 40s and by the time you get to your 60s, you're retired, you've held that property for 20, 25 years. As you can imagine, you're going to have a lot of equity. There's going to be a lot of land value components. So it's a tax that gets worse over time, and it's a tax that is at its worst at a time when you really want to be income. When you want to be minimising your taxes. So, I've got a client in Sydney. He inherited a little bit of property from his father, but really he's been a successful property investor for a long time. He's been buying since the 80s. And he's done incredibly well. There's no doubt about it. And so I'm not telling you the story so people feel sorry for him by any stretch of the imagination. But his land tax bill eats up about 45% of his net rental income. That's a lot of money. And there's nothing he can do about it, because if you change the ownership of a property, it'll trigger capital gains tax and stamp duty typically. So you're kind of stuck in an ownership structure, and then you're paying a lot of land tax. And now, again, it's no big deal for him. He's in a very strong, a strong financial position. But I'd imagine if he could go back and talk to himself in the 80s, he'd start really thinking deeply about it, and there would have been ways that he could have minimised it.
I guess this can also be an even bigger thing if we are going to pass on properties and have multi-generational wealth, because our inherited, those that receive our inheritance are going to have this to deal with too. And if their focus is more on income at that stage as well, then, these things are going to be important too.
Yeah, and if you have a really heavy land value type property, it's possible that you end up passing on something that might be negative cash flow too. You're passing on an income liability each year. Sure, you've got a very valuable asset, I'm sure. So anyone that's going to give you a valuable asset, of course, you're not going to say no. But, it's just one of those things that I guess when we first start investing, we don't really think what's going to happen in 20 or 30 years' time. And it's a long time to project, and lots of things can change over that time, including the tax system. Although I can't ever imagine a time where they'll get rid of land tax. So I think it's going to be around for a long time in some way or form.
And the best investors I've met And it's been a gradual process of me dragging up my thinking from that incredible short term, I'm buying a property, I'm renovating it, I'm selling it, other variations of that, to what's actually going to be an asset to hold for the rest of my life. And then thinking generational as to what am I going to pass on? What am I going to teach my kids? How are we going to set this all up to keep us from slipping back to the middle class, if you will. Not that there's anything wrong with it, but if you spend your life building and moving you upwards in the your wealth, you'd want it to continue if possible for the next generation.
It's a completely different mindset, and that mindset that you adopt to take that long-term view is incredibly valuable because it will encourage you to make really good quality decisions. But also it's incredibly valuable when it comes to tax too, because to be too short-term focused with tax, and you sort of mentioned, Jared, a little while ago about the accountants, that's what they're doing too, and to be honest, I would wholeheartedly agree. Accountants spend a lot of their time thinking about the past 12 months and maybe a little bit about their time thinking about the next 12 months, but not really beyond that. Whereas financial advisors tend to be thinking about what's going to happen over the next 10, 20 years, very sort of long-term view, where we're heading, where we're going. And you really need, so people need to be conscious, I think, of that's the mentality, which isn't a criticism of accountants, it's an observation. That they need to be, they're doing what they're doing. That's their job. But when we're thinking about our own investments and we're then thinking about the questions to ask our accountants, we really need to.
Well, I guess if they're responding to how do I save tax this year as the primary question, or, how do I make this more affordable over the next few years to hold the property as the primary questions, then they're going to answer that and slant their advice possibly towards that as well.
Yeah. That's right. Yeah.
So what are some of the income tax considerations if we now go through each of the three sort of core tax areas? Might be more than three, but
yeah,
we'll see.
Yeah, sure.
When it comes to income tax, what are some of the considerations there?
So income tax is going to depend on the phase that the property is going through. And of course, then you might have several properties and they might be at different sort of phases. But the negative gearing phase from an income tax perspective, obviously you would like to have the loss in the person that has the highest tax rate, the highest taxable income, because that's going to mean that their loss is taxed at their highest marginal rate. If that's 47% or 39%, which are the two top tax brackets, and most people are going to fall into those tax brackets, then that's going to maximize. But the problem then
effectively get more deductions along the way because of that higher tax bracket if it was put solely or mostly in the name of that higher tax.
Yep, spot on. But the consequences of doing that, because that's just being sort of, I guess, a common sort of reaction from accountants. Buy an investment property, it's negatively geared, put it in the highest income earner's name. Now, the problem with that, though, in the longer term, is that let's say the wife has the highest income, the husband has the lowest income. They go and buy three investment properties. They put them all in the wife's name. Now, that's great while they're working, but then as soon as they retire, maybe they're drawing super pensions or whatever, well, that's tax-free. And so then all the rental income goes to the wife. Now, let's say that there's $60,000 of net rental income. She's going to pay $11,000 in tax. Whereas if those properties were owned equally between the two of them, she'd pay $4,000 in tax. So we're not talking about big numbers here. It's $7,000 difference. But at the end of the day, when you're retired and you're relying upon investment income to fund living expenses, you want to be paying less tax rather than more. So this
and it obviously scales up, the higher that income is.
Exactly right. Yeah. So it's going to become a compounding problem. If it's $7,000 difference when you first retire, in 10 years after retirement, it's going to be more. It's never going to get less. So it's going to get worse. So you might, in that situation, what do you do? Well, I would say that when people start investing, they tend to have a relatively weak financial position, and that's why they're starting investing. So tax benefits and cash flow and maximizing negative cash flow or after-tax cash flow, I should say, is important. So putting that first property in the highest income earner's name probably makes sense. And maybe it even makes sense to some degree for the second property, but maybe less so. But when it comes to the third property, in using that example, well, that's when you might look for some diversification. And you might say, look, we could put it in the wife's name because she's a higher income earner, but how much marginal tax benefit will we get? And maybe we're better off putting it in a different entity, whether that's in the husband's name, a super fund or a trust or joint names, whatever it might be. It's going to depend on their situation, of course. But that's when sort of taking that longer term view and not being just laser focused on how much tax can I save over the next 12 months, but really taking that balanced view and saying, well, maybe I'll forego a little bit of tax saving earlier on so that I can save more tax down the track.
And there's other factors that obviously go into that case by case. Will one spouse work longer and the other one could be without an income entirely that could be receiving that, a large amount of that rental income with little tax. That's
right. And, that's the best thing, Jared, that a long-term plan provides is context for making these decisions, right? So if you don't know what your long-term plan looks like, then you don't really have a context. You can ask me, Stuart, what name should I put this property in? Well, I don't have a context. I don't know, where you're going, what you're going to do, what your incomes will be in the future, when you're going to retire, all those sorts of things. So, and it's not necessary that you have to sit down and have a super detailed plan about what's going to happen in 20 years, because of course it's very difficult to predict. But not paying any attention to it or not giving it any thought is probably equally silly as well.
So the next tax that we've got to consider, land tax. We spoke of it earlier. What are some of the thoughts there?
So as I said, it's a state-based tax. So one of the easy ways to minimise it is to spread properties across various states. Because typically each state has their tax-free threshold, and that's going to be in different states. In WA, it's 300,000. It's 250,000 in Victoria. New South Wales is kind enough to index theirs. I think it's approaching 600,000. I don't know Queensland off the top of my head. I think it's closer to 200 odd thousand. So, but either way, you're not going to pay very much tax if you have less than $1 million worth of land value. And remember, I'm talking about land value rather than the property value in each of those states. Now, sometimes people don't feel comfortable doing that. We tend to like to invest in areas that we know. We like the fact that property is material. It's there. You can drive past it. You can see it. If anything goes wrong, you can deal with it. But equally, I think if you're going to be a professional investor, there's certainly ways and means to invest outside of your domicile state in a way that's prudent and provides not only some geographical diversification from an investment perspective, but also then some tax benefits. If you're just sort of state focused, so you're not going to invest outside of your state, then think very carefully about using a family trust in some states. So there's some states that charge much higher land tax rates if you put a property in a family trust. And in that situation, you might be better off putting a property in a company. Now, most people or most accountants will go, no, don't put a property in a company because a company doesn't get the 50% capital gains tax discount. So you'll pay a lot more capital gains tax. But with the reduction of the company tax rate down to 25%, if you're able to avail yourself of that lower tax rate, it's less costly, more costly. Like it's more attractive.
If you're on the
now.
top tax bracket anyway at 47 cents, and that's 23.5.
Yep.
The 50% reduction, very close to the 25.
25, that's it. So you're not paying that much more, but, you might be saving $10,000 a year in land tax. So, it sort of speaks for itself. So typically investing in your own personal name, there's not much you can do to minimise land tax. Even spreading properties amongst spouses, those sorts of things. You can do a little bit to minimise land tax, but really I think... So if anyone's already got a couple of properties in their state, I would encourage them to think about investing interstate, not purely just based on land tax. I think there's lots of good reasons to do that. But particularly if you're going to use entities, be very careful. In some jurisdictions, and you've got multiple properties, you put them in multiple trusts. Other jurisdictions, you might use a company. Sometimes it's just much better to go personal name. But I think it's just really about understanding the regime and then understanding how your decisions today might impact you longer term, as we've talked about. It's a tax that tends to creep up on us.
Thanks for joining me for part 1 of our discussion on minimising tax. We've got Stuart coming back for part 2 in our next episode, where we're going to touch on the all-important capital gains tax and the considerations we need to keep in mind there. And we're going to go into the use of trusts and structures, who they're for, what are the benefits, what are the downsides, and then how to go about finding a tax advisor and some really good advice about what is a holistic accountant, and some of my personal experiences when seeking out the right accountant at the various stages of my journey. So let's catch you on the next one.